Hello and welcome to this session in which we will discuss short-term versus long-term financing. Here we are discussing on how the company finances itself. Well, if you're borrowing money, you can borrow money for short-term period or you can borrow money for long-term. We're going to look at the characteristic of both short-term financing, long-term financing, look at examples, advantages and disadvantages. We're going to start to look at short-term financing. And this term refers to any financial instrument and any borrowing mechanism. Anytime you borrow money, and that money is for a short period of time. The time frame is less than a year. So you borrowed money to run your business, to fund your business, but you have to pay the money back within a year, less than a year. This is how short-term financing is defined. It helps the business. The purpose for this is immediate cash flow needs. So you want to, if you have an opportunity, you need some cash to finance it, you want to manage some shortfalls due to seasonal demand fluctuation. Some businesses, what they do at some time during the year, their sales goes down due to its seasonal fluctuation. Therefore, they need some money to kind of patch up. That's when they need short-term financing. For example, they might want to buy inventory, make the payroll for that quarter, or short-term liquidity shortfall. Any reason they have short-term, they need money real quick. The first thing we're going to do is we're going to look at some examples of short-term financing. Then we will look at the advantages and disadvantages of using short-term versus long-term financing. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
What are some examples of short-term financing? Well, bank loans. Bank loan could be less than a year. Bank overdraft. Bank overdraft is when the bank allows you, or they cover any shortcoming you have. So let's assume you have $100,000 in the bank. You took more money than $100,000. If you have a bank overdraft, up to a point, the bank will cover this amount. Companies can also use trade credit, which is accounts payable. That's what trade credit is. It's basically buying and paying for the goods and services later. Basically, you are financing yourself. Usually, you have to pay within a short period of time. Commercial paper is another form of short-term financing. Is where you have to do what? Borrow money for a short period of time. Basically, you issue a paper, they'll give you the money. Lines of credit, think of a credit card where the bank says you have a certain amount of money you can tap into, get them out and use them. Factoring services. Factoring services is when you have a receivable, and what you do with that receivable, you use that receivable to finance your operation. For example, if you have $1 million worth of receivable, in other words, account receivable of that much, you're waiting to be paid in 30 or 60 days. You go to the bank and you ask the bank, well, I'm gonna put this receivable as a collateral. Would you mind giving me a loan? Or you can sell it, or you can get a loan against that receivable. This is called factoring services. The point here is anytime you borrow money for a short time is short-term financing. What's a short time? Less than a year. What are the advantages of using the short-term financing? Is the speed. Usually you'll get the money quicker. They don't need to do a lot of in comparison to long-term financing, because long-term financing option, the lender will take more time because they are making a long commitment. Usually it's the speed. You can get the money faster. Usually you are charged lower interest rate. Why? Because there is less risk for the lender. The lender is lending you the money for a short period of time. They're going to get their money soon. Therefore, they're taking less risk. Therefore, it's lower interest rate compared to long-term debt, compared to long-term financing. So always when we say, lower than what? Lower than long-term financing. Less cumbersome, as we mentioned, the speed, the documentation, and the collateral may be less stringent, again, than long-term debt. And there's a flexibility in financing. Businesses can take out short-term loans to meet variable cash flow needs and pay them back when it's most convenient because it's for a short period of time. And the good thing, it's no long-term commitment. Now you're going to see no long-term commitment. Also, it's a disadvantage. We're going to see how. So businesses avoid the long-term obligation that can restrict future financial actions. Those are some of the advantages of short-term financing. Just like we have advantages, we have disadvantages. The first disadvantage is refinancing risk. Since short-term loans need to be paid back or refinanced in short period, there's a constant need to do what? To keep negotiating new loans, leading to refinancing risk. And this sometimes happened in a real case from GE, General Electric. At some point, they were using short-term financing because the interest rate was lower. And they were happy with that interest rate until they ran into the refinancing risk where they could not refinance their obligations. And they got into trouble. Frequent negotiation. Because of this refinancing risk, you're always renegotiating the terms. It could be burdensome and uncertain whether they're going to give you the loan or not. Cash flow pressure. You have to pay back this money in the short term. So you have to pay a large amount, usually the full amount. What does that mean? Putting pressure on your cash flow. Especially if the company's earning is not predictable, you might have to come up with a lot of money. And it's not suitable for all type of investments. As I told you, for example, when GE was doing this, they were using short-term borrowing to finance their long-term project. So they constantly needed frequent negotiation and refinancing risk, which is at some point the liquidity market froze and they could not refinance. So some capital investment that have longer payback period may not be suitable through short-term debt. And this is exactly what GE was doing because they were greedy. They said, okay, we can do this using lower rate. Big mistake, big mistake. And the risk of non-renewal, which is the risk of refinancing, same thing. Especially when it comes to line of credit and other short-term facilities, they may not renew. Well, if they may not renew, then you don't have room or you don't have place to go for cash. Let's talk about long-term financing. Obviously, by its definition, if short-term is less than a year, long-term is when you borrow the money for typically more than a year. And this kind of financing usually used to buy assets, expanding operations, strategic initiative, property, plant and equipment, expensive items. Some examples of long-term financing instrument: loan. A loan could be short-term, a loan could be long-term, and that's why I had the same picture for both to remind you, depending on the term of the loan. And this loan often used is to do what? To purchase equipment or long-term investments. Another form of long-term borrowing is bonds, issued by corporation or government to raise capital. They could range from 1 year to 30 years. Same thing as loan, except bonds, you are not going to a particular lender. You are selling your paper to anyone. Anyone can lend you money. Mortgage, same thing as a loan, except the loan is secured. You are putting up a collateral. So in case you cannot pay off the loan, the lender can take the asset. And as a result, you get a lower rate when you have those mortgages. Lease financing, another form of financing. Again, you can finance equipment, property, plant and equipment as well. The lessee obtained the right to use the equipment in exchange for payments. And debenture, similar to bonds, except debentures are unsecured. Simply put, you're issuing the bond and it's not backed by any asset like a mortgage. Mortgage, it's a secured loan. Debenture is unsecured. It means you are selling the bond, getting the money, and whoever is giving you the money is not getting any security in return. Characteristic of long-term financing: the interest rate. As we mentioned, short-term debt has a lower rate. Long-term debt has a higher rate. Why? Because whoever lending you the money, they have to wait for a long period of time to get their money. Therefore, the longer they wait, the longer they're going to have to charge you because they're taking risk. Repayment. Well, scheduled repayment are usually made monthly, quarterly, or annually. So that's how long-term debt are due. They're not all due at once. Security long-term financing often require collateral, as we mentioned, or security against the loan, especially in case of large amount. And long-term debt usually involve covenants. And we have one whole session about covenant where the lender imposed conditions, imposed certain limitations on you that you have to agree with in order to obtain the loan and get your money. Advantages of long-term debt is amortization. As we mentioned, the payments are spread over many periods, quarterly, monthly, for long period of time, versus short-term where you have to come up with everything all at once. Cash flow management, lower monthly payment compared to short-term financing where everything is due all at once. Usually, if you can get a fixed interest rate, that's really good because it helps with budgeting and financial planning. obviously you're going to get a tax benefit. But this tax benefit is for both, for short-term and long-term, because interest is tax deductible. And we talked about how to compute the net cost of borrowing. And let me do it again. We did it in several chapters. So if we have a loan and we're paying 10% interest on that loan, but our tax rate is 30%. Because of that 10% interest, we'll take 10% times 1 minus 0.3, the tax rate equal to 10% times 0.7, which is your rate is 7%. So although you're paying 10, but your net cost after interest, net cost after tax, not after interest, the net cost of interest is only 7%. Why? Because you save on your taxes. And obviously leverage, company could use leverage to potentially increase the return, but leverage is a double edge. So we can say leverage is an advantage and leverage is a disadvantage. Because if you are earning more than what you are borrowing, it's an advantage. If you are earning less, it's a disadvantage. So be careful, leverage is a double-edged sword. It could be part of disadvantages. The first disadvantage is interest cost. The longer the loan, the more interest you have to pay, generally speaking. Risk of interest fluctuation. If you have a variable rate, you're taking even more risk because as time goes by, you don't know the future, rate could change. Asset encumbrance. You have to put up collateral for that loan. Well, if you have to put up collateral, they are kind of basically, there's a burden on your asset because you have it as a collateral. There's also sometimes prepayment penalties for loans, especially long-term loans, because the lender, they don't want you to pay the money because the interest rate might be lower and you might do it when the interest rate is lower so you can refinance. They want to protect themselves, therefore they will charge you penalties if you pay early. Let's take a look at this multiple choice question from Farhat Lectures. ABC Manufacturing is considering financing options to cover its operational cost for the next 3 months due to a temporary dip in sales. Which option is the least suitable for the short-term need? So look, it's short-term, it's a 3 month, we need the loan for 3 months, and which option is not suitable? So you have to be careful when it says not suitable because you're going to have 3 suitable, and if you read which option is suitable, and you're going to have 3 options and you might answer this question incorrectly really quick. So the least suitable of the 3 is what? Is line of credit a short-term borrowing? Yes, line of credit is a form of short-term borrowing. Of course it is. Bank overdraft. Yes, we talked about bank overdraft where you do what? You agree with the bank that in case you went over your limit for a certain amount of money, they cover you. That's also part of your short-term financing. Account receivable financing. What is that? Account receivable financing. Account receivable financing is when you put up your account receivable as a collateral for a loan. So you would say, okay, I'm gonna be getting money in the next 30 days. And what I'm gonna do, if you give me the money now in the next 30 days, any money that I collect, I will give it to you. It's a form of short-term financing. Although I did not mention it, but there you go, it's short-term financing. How about equity financing? Stocks. Do you issue stocks to finance a temporary dip in sales? That's really bad news if you do that. Therefore, equity financing is not a form of short-term borrowing. It could be considered financing in the long term. Could be, if you want, nothing wrong with thinking of it this way, but it's definitely not to, you don't issue stocks because you have a temporary dip in your sales. What should you do now? Go to Farhat Lectures, look at additional MCQs. That's going to help you prepare better for your CPA exam. Invest in yourself. Good luck, study hard, the CPA exam is worth it, and stay safe.